My dear students, welcome back to our channel. Students, in this video I am explaining important long questions and answers. Let's start quick revision. First unit. First important question is: explain the objectives importance of accounting. Objectives importance of accounting. Accounting is the process of recording, classifying, and summarizing financial transactions to provide useful information for decision-making. It's essential for businesses and individuals to keep track of their finances. Here's why accounting is important. 1. Helps in decision-making. Accounting provides information that helps business owners, managers, and investors make informed decisions. For example, if a business owner knows how much profit they are making, they can decide whether to expand or save more money. Example: a small business owner uses accounting to track sales, expenses, and profits. If they notice that their expenses are too high, they might decide to cut costs or increase prices. 2. Maintains financial control. Through accounting, businesses can monitor their income and expenses, ensuring they don't overspend. This helps in maintaining financial stability. Example: a company may use accounting to control how much money they spend on supplies. If their accounting records show that spending is too high, they can look for cheaper suppliers. 3. Prepares for taxes. Accounting helps businesses calculate and report their income and expenses, which is important for filing taxes. Without proper accounting, a business might face problems with tax authorities. Example: a company needs to keep accurate records to calculate how much tax they owe to the government. Without proper accounting, they may miss important details and face fines. 4. Facilitates communication. Accounting allows business owners to communicate financial performance to others, such as investors, creditors, and employees. Clear financial records help build trust. Example: an investor uses financial statements, which are prepared through accounting, to decide if they want to invest in a company. Conclusion. In short, accounting is crucial because it helps businesses track their financial performance, make decisions, stay organized, pay taxes, and communicate with others. Without proper accounting, managing a business or even personal finances would be very challenging. Next important short question is: explain briefly the basic concepts and conventions of accounting. Basic concepts and conventions of accounting. Accounting involves various principles and rules that guide how financial information is recorded, processed, and reported. These are called basic concepts and conventions. Let's break them down. 1. Basic concepts. A. Business entity concept. This concept states that the business is separate from its owner. The personal finances of the owner should not be mixed with the business finances. Example: if you own a cafe, the money you use for personal expenses, like groceries, should not be included in the cafe's accounting records. B. Money measurement concept. This means only transactions that can be measured in terms of money are recorded. Non-monetary items, like employee skills or customer loyalty, are not recorded. Example: if a company gets a new office computer, the purchase is recorded because it has a monetary value. C. Going concern concept. This assumption suggests that a business will continue operating for the foreseeable future unless there is evidence to the contrary. Example, a company will not value its assets as if it is closing down because it assumes it will keep running. D. Cost concept. This means that assets are recorded at the price paid to acquire them, not their current market value. Example, if a business buys a building for $100,000, that price will be recorded, even if the building's value increases to $150,000. 2. Basic conventions. A. Consistency convention. This principle states that businesses should use the same accounting methods year after year to ensure comparability of financial statements. Example, if a company decides to use the straight-line method of depreciation, it should continue using that method each year unless there's a valid reason to change. B. Accrual convention. Under this rule, revenues and expenses are recorded when they occur, not when money is received or paid. Example, a company may make a sale in December, but if the customer pays in January, the sale is still recorded in December. C. Conservatism convention. This suggests that when choosing between different methods, accountants should choose the one that least likely overstates assets or income. Example, if a company is unsure about the value of inventory, they should report it at the lower value to avoid overstating their profits. Conclusion. Accounting concepts and conventions guide how financial transactions are recorded and reported. The basic concepts ensure clarity in business transactions, while the conventions help keep the records consistent and conservative. Following these rules is crucial for maintaining accurate, trustworthy financial information. Next important short question is: discuss the implications of generally accepted accounting principles on accounting system. Implications of generally accepted accounting principles, GAAP, on accounting system. Generally accepted accounting principles, GAAP, are a set of standardized guidelines used in the preparation of financial statements. These principles ensure consistency, reliability, and transparency in accounting practices. The implications of GAAP on an accounting system are significant because they influence how transactions are recorded, reported, and interpreted. 1. Standardization and consistency. GAAP ensures that businesses follow the same accounting rules, which makes financial statements comparable across different companies and industries. This helps investors, creditors, and other stakeholders understand the financial health of a business. Example, if two companies are reporting their profits, GAAP ensures both follow the same method of recognizing revenue and calculating expenses. This makes it easier to compare their financial performance. 2. Transparency and accuracy. GAAP requires detailed and clear reporting of financial transactions. This transparency helps stakeholders make informed decisions and trust the financial data provided by a company. Example, a company must disclose its inventory methods, example, FIFO or LIFO, in its financial statements, so investors can understand how inventory affects profits. This reduces the risk of misleading financial reporting. 3. Improved decision-making. By following GAAP, companies ensure that their financial reports are accurate and reliable. This leads to better decision-making by management, investors, and lenders. Example, a business owner will know the true financial position of the company whether it's making a profit or loss because the accounting system is based on consistent and reliable principles. 4. Legal compliance and credibility. Adhering to GAAP ensures that a company's financial reports are legally compliant, avoiding penalties for misreporting. It also enhances the credibility of the business in the eyes of investors, banks, and regulators. Example: a publicly traded company must follow GAAP when preparing its financial statements. Failing to do so could lead to legal action and loss of investor confidence. Conclusion: the implications of GAAP on accounting systems are significant. They ensure consistency, transparency, accuracy, and legal compliance in financial reporting. For businesses, GAAP enhances decision-making and helps maintain trust with stakeholders, making it essential for maintaining a reliable and credible accounting system. Next important short question is: what is bookkeeping? Differentiate between single entry and double entry with examples. What is bookkeeping? Bookkeeping is the process of recording all financial transactions of a business. It involves keeping track of money coming in and going out, ensuring accurate records of income, expenses, and other financial activities. Bookkeeping helps businesses stay organized and makes it easier to prepare financial reports like balance sheets and income statements. Difference between single entry and double entry. Bookkeeping can be done using two main systems: single entry and double entry. Let's look at the differences. 1. Single entry system. Definition: in the single entry system, each financial transaction is recorded only once. This system is simpler and often used by small businesses or individuals. Recording method: only one side of each transaction is recorded, either the debit, money coming in, or the credit, money going out. Example: if you buy a computer for $500 in a single entry system, you would only record the expense of $500. There's no tracking of where the money came from, like a bank account or cash. Limitations: it's not very detailed, so it's harder to detect errors or prepare complete financial reports. Example: you sell goods for $200. You record the sale as plus $200. There's no entry to show where the $200 went, example, cash or bank. 2. Double entry system. Definition: the double entry system is more comprehensive and is the standard for most businesses. In this system, every transaction is recorded twice, once as a debit and once as a credit. This ensures the accounting equation, assets is equal to liabilities plus equity, stays balanced. Recording method: for every transaction, there are two entries made. One on the debit side and one on the credit side. Example: if you buy a computer for $500 in a double entry system, you would record $500 as an expense, debit, and $500 as a decrease in cash or bank credit. Advantages: this system gives a clearer picture of the business's financial health, and it helps detect errors easily. Example: you sell goods for $200. O debit, cash, plus $200. O credit, sales revenue, plus $200. Conclusion: the key difference between single entry and double entry bookkeeping is that single entry records only one side of a transaction, while double entry records both sides, making it more accurate and detailed. The double entry system is more reliable for businesses, ensuring that all transactions are balanced, while the single entry system is simpler but less comprehensive. Next important short question is: define accounting. Explain different types of accounts with entry rules and suitable examples. What is accounting? Accounting is the process of recording, classifying, summarizing, and interpreting financial transactions of a business. It helps in providing accurate financial information to help make business decisions. The main goal of accounting is to track the inflow and outflow of money, ensuring that the business runs efficiently and stays financially healthy. Different types of accounts. In accounting, there are three main types of accounts: personal accounts, real accounts, and nominal accounts. Each has its own entry rules, which help guide how transactions are recorded. 1. Personal accounts. Definition: personal accounts are related to individuals, companies, or organizations with whom a business has transactions. Rule: debit the receiver, credit the giver. Example: if you sell goods to a customer, you would debit the customer's account because they are receiving the goods, and credit the sales revenue account because you are giving the goods away in exchange for money. Example entry: debit, customer account, receiving goods. Credit, sales revenue account, giving goods. 2. Real accounts. Definition: real accounts represent the business's assets, things the company owns, or liabilities, things the company owes. Rule: debit what comes in, credit what goes out. Example: if a business buys a machine for $5,000, the machine, an asset, is coming into the business, so you debit the machine account and credit the cash account, money going out. Example entry: debit, machine account, asset coming in. Credit, cash account, money going out. 3. Nominal accounts. Definition: nominal accounts track income, expenses, and losses. These are temporary accounts that reset to zero at the end of the accounting period. Rule: debit all expenses and losses, credit all incomes and gains. Example: if the company spends $1,000 on rent, the rent expense and expense account is debited, and the cash, money going out, is credited. Example entry: debit, rent expense account, expense. Credit, cash account, money going out. Conclusion: in accounting, the three types of accounts, personal, real, and nominal, are essential for tracking all financial transactions. Each type has its own rules for how to record transactions, helping businesses maintain clear and accurate financial records. I hope you understand easily each question. All the best, students, for your upcoming exam. For other subject quick revision, important questions, previous question papers, and syllabus. Links are available in description. Check out once. Thank you for watching. Like and share this video with your friends.